Some major changes are taking place in the US economy and the crypto markets. Changes that will not only affect your crypto portfolios and XRP adversely, but affect the timeline at which we can all retire. And all of the recent bearish headlines and volatility recently has a lot of investors spooked, which could lead you to panic on a bit of downside, potentially capitulating and selling at local bottoms, when in reality, you should be using those opportunities to accumulate good, strong, sound assets. And if we truly start to see some strength in the markets here, then Morgan Stanley is right. And the bull market of 2024 is still truly on, and all dips are for one thing, and that is buying. Now, I understand the last 6 months have been difficult and boring, as Bitcoin and other markets have not only seen an intermediate term downtrend, but just have failed to break to new highs. Ultimately, we can't take our eyes off the goal here, and that is to use opportunities of major volatility to the downside to our advantage. While markets dump and others capitulate, we accumulate. That's how we retire early. We plan and prepare and arm ourselves with the right information to make better decisions about what to do with our portfolios. So in this video, I'll help you prepare by sharing exactly how the recent dump and rally in broader US markets can affect crypto, how hedge funds are managing risk and equities right now, how a recent report from Morgan Stanley says we are likely still going to see new highs at the end of 2024, and some things to look out for that can point towards general market weakness and create volatility to the downside, like US Treasury yields, the labor market, manufacturing and transportation, and what this all means for crypto, XRP, and some major support and buy zones if we dump one more time. And as always, before we begin the video, head on over to bullrunners.com. You can find the link in the description below, and subscribe to learn how to take advantage of this all market solution. Doesn't matter if it's a bear market or a bull market, you can discover how to earn more crypto in less than 10 minutes with the #1 play to earn XRP game. So if you're feeling blessed and bullish, comment 777. And if you're going to be the richest person in your family tree, smash the subscribe button. Before we dive in, a quick reminder that the opinions in this video are for informational and educational purposes only and do not constitute financial, legal, or investment advice. All investments, including cryptos, carry risks and potential losses. Always do your own research and consult with a licensed financial advisor. We are not licensed financial advisors, and relying on our content for financial decisions is at your own risk. By watching this video, you agree we are not responsible for any losses or damages, and we do not guarantee any specific results or outcomes. Some of the links below may be affiliate links, and we may earn a commission, which actually helps support this channel and helps us to create value-based videos like this. We also hold some positions in the cryptocurrencies that we talk about, but that's only because we do what we believe in. However, this should not be interpreted as a recommendation for you to do the same. With that said, let's get into the video. Now, on August 5th, when the Bank of Japan on the carry trade caused the general TradFi markets to collapse, including the S&P 500, you can see that we were down from a high of 5,600 and we dumped all the way to 5,100. There was a lot of panic in the markets. We've actually recovered the majority of that move and have seen some weakness over the last day or so. And this caused a lot of folks to generally have fear surrounding the market and a potential economic downturn or a recession. As you can see here on Poly Markets, on August 5th, we had a 41% chance, according to the betting market, of seeing a recession. But that has actually dumped all to 10%, which is really very low. Now, the reality is we're likely, even if the markets start to look recessionary, not going to get an actual recessionary reading in terms of 2 consecutive quarters of negative GDP growth as a reading from the Bureau of Economic Analysis. And what's interesting is we in 2022 did have that occur, and even then, under the Biden administration, never came out and directly said that we are in a recession, because that would have looked bad on their report. So to reiterate, even if we see the markets continue to see a downturn or a potential recessionary environment, it doesn't necessarily mean that the Bureau of Economic Analysis is actually going to come out and say it. Which is why it's probably better to actually look to the market and the price action to tell you, not necessarily any bureau from the government. Now, that said, the S&P 500 saw a recent high at 5670. Okay, since that point in time on the Bank of Japan news, we broke down pretty heavily, and this caused a lot of fear in the markets. A lot of people capitulated. There was a lot of leverage that basically made its way out of the system. But since that point in time, I don't believe we're fully out of the woods just yet, even though we saw this strong rally, which really just indicates to me that there are a lot of folks that believe that this was a dip buying opportunity, and I would argue potentially, but I do think we might see some more volatility to the downside. So that said, here is the trend line, and whenever I see this type of a breakdown on some pretty serious volume, chances are we might actually continue to make new lows, especially from a daily time frame. If we continue to break back down below this trend line, then this would truly be a bear trap and arguably fail to break above this high. Now, even if we did break above that high and only broke down below this trend line yet again, we'd have a bear trap right here. So this could be a potential bull trap. My apologies for getting that wrong for a second. And this would be a bear trap. The market rallies to a new high only to break back down for a new low. And so a real bear market, in my opinion, or at least an intermediate term bear market, would be if we broke below this recent low. Now, the reality is the crypto market is likely going to follow suit if this happens in the general broader market. And up top, I have a chart of Bitcoin. I'll go ahead and get rid of that watch list for a second. And down below, I have the chart of the S&P 500. Now, you can see they don't always trade exactly alike, right? Bitcoin tends to be more volatile. It's a far smaller market cap, and so it's easier to move. And arguably, it's sold off typically a bit, more and first relative to the general stock market. That said, you can see that we had a local high that came in early on Bitcoin, and then a local high on the S&P 500 shortly thereafter. So it looks like Bitcoin was leading the market. Then what happened was the S&P failed to rally and break to new highs here, even though it started trending up while Bitcoin was trending down and seeing a relative weakness, only to see the S&P 500 dump right around here. Okay, at the same time we saw the collapse on Bitcoin to its major low at $3,200. Then in that period of time, both rallied and we started seeing some sort of a new bull market trend. As you can see here, we had a first major high, a new higher low, and then a new all-time high in the year of 2021. In similar fashion, right around here on the S&P 500, right, we did see the market trend higher, only to collapse on the coronavirus pandemic. In other words, this was that really interesting period of time where we saw some insane volatility, which caused a buy opportunity. And I do believe this is what we might likely see yet again. Now, the S&P 500 did put in a double bottom right here. You can see here, I'll get this out of the way. Right here, a double bottom at about $2,300. We did break down just slightly below there on the S&P, but we saw major wicks or buy pressure on the downside. So that was a textbook double bottom, whereas we saw more strength on the buying and the dip on Bitcoin for a new higher low, not a double bottom. But in union, they both continue to rally. And this is what you call a risk on environment. Okay, this is where fund managers and institutional players tend to take more risk in order to earn more of a gain or a reward. In other words, they are very highly correlated as risk on assets. Now, let's just define this a bit more clearly. When risk on signals are shown, investors are willing to take larger risks in the hopes for a larger return. When risk off signals are shown, investors tend to limit the amount of risk they take in the hopes that mitigating a larger loss and shifting to a more defensive stance. So typically that would indicate people are starting to sit on cash or to buy gold or to get into asset classes that are going to be less volatile in the potential downturn. That said, risk on trading, broadly speaking, this would mean favors equities and are growth oriented, emerging markets, or speculative non-traditional investments. And in reality, we could just replace that with crypto. So I understand this argument, right, that Bitcoin is kind of like a store of value and eventually it's meant to look like gold. But as things stand, that is just not the case or the truth. And in similar fashion, right here, you can see Bitcoin pumped to a new all-time high in 2021 in November. The S&P 500 was lagging slightly behind it, and then it started selling off on both ends, right? We saw the sell-off first occur in Bitcoin, and then shortly thereafter it happened in the S&P 500. Both started trending down, almost bottomed around the same time. Okay, the S&P 500 bottomed a little bit sooner, and this was due to the FTX crash right back here, and then both continued to rally. Now in this period of time when Bitcoin actually saw its new all-time high in March 7th of 2024, okay, it's failed to break above that high, and this is what's caused a lot of people to get bored and tired of the crypto markets, capitulate. We've seen an intermediate term downtrend, a summer lull, a squat, if you will, in the price, while the S&P 500 continued to rally. However, as you recognize back here, the S&P 500 is not new to doing this, right? The S&P 500 rallies a bit, while Bitcoin actually tends to dump a bit. And Bitcoin is typically a leading indicator of what's to come in the TradFi markets. And the same exact thing happened here in 2017. You see Bitcoin actually topped off, okay, and then shortly thereafter, we saw the exact same thing as Bitcoin was making its new downtrend happen in the S&P 500. Then it topped and then started to dump and failed to break to new highs before putting in some major lows the next year. Now that said, if this truly was the top on Bitcoin and this is telling us or giving us a signal that the markets are done rallying and trending to the upside before we see some sort of major volatility and then continue moving up, and the volatility would typically happen to the downside, similar to what happened back here, right? And where did it go? In March of 2020, right? Yes, we were trending up, and as you can see here, we're putting higher highs, higher lows, and a new uptrend only to see a major sell-off and volatility right here before making a new major all-time high. So in similar fashion, it could happen or be the case that this is a signal of an early topping period only to break down for a major volatility event down to like 42 to 40,000 or even potentially lower and being tipped right at the $31,000 level before seeing a major wick and some buy pressure to the upside. So that said, what I would be looking out for is a breakdown on the S&P 500. And if that continues to happen and we start to see some weakness here or even a double top or a bull trap up here for a breakdown, then if we get a new lower low below the 5,200 to 5,100 range, then chances are Bitcoin is going to follow, and this will be some major volatility that I would actually like to accumulate or buy into. So let's get into some of the news, and then we'll dive into XRP, the chart, and some major buying potential or buy zones that you should be aware of. Also, before we move on, head on over to bullrunners.com and subscribe to put your XRP to work. This is no bullshit, my friend. This is the #1 play to earn XRP game. Yes, if you're already holding XRP or you plan to accumulate more XRP, this is a great way to reduce your volatility or risk in the case of a market downturn. And on the flip side, if the markets start to turn hot and start to trend to the upside, then this is a great way to compound or add to that bag before for the major move and the end of the bull market. You can discover how to earn more crypto by subscribing. And yes, you're actually earning crypto, which is convertible for XRP. Here in this video, Nick explains exactly how it works and why it works. And in 3 simple steps, this is how easy it is to do. You get your XRP wallet 1, then you go and get your game pieces. And then finally, the 3rd step is you play the game, you earn the crypto. It takes no more than 10 minutes per day. And guess what? Yes, the crypto is convertible for XRP at any time. So go ahead and go to bullrunners.com and let's get back into the video. So there are currently some factors that are still not in the rear view, but directly ahead of us that we have to be patient and watch for. Some of those including the Fed and other things surrounding the economy, like the jobs or unemployment, readings, so on and so forth. So that said, here is an article from Macquarie, which I found quite interesting, recently published, second quarter 2024 recap. They said this: the recent macroeconomic environment has been characterized by a complex interplay between inflation, economic resilience, and that is definitely true, right? Markets have failed to severely break down, and every breakdown, even the Bank of Japan, the BOJ breakdown, failed to really hold its ground and only got bought right back up. However, I do believe it might be a fake out. Economic resilience and shifting U.S. Federal Reserve expectations. So a lot of people have consistently actually been buying into the expectation that the Fed is going to lower interest rates, but more often than not, after they lower the interest rate for the first time is when you want to start to look at getting out. So if they don't lower the interest rates come September, then the markets are probably going to continue to rally in the expectation of it. In other words, markets are typically forward looking and they discount things on the spot. That said, we continue to believe that the equity investors expect central banks to start cutting interest rates in 2024, given the evidence that inflation is continuing to decline in most countries. And they have kept interest rates extremely high for a very long period of time now. That said, economic data, especially around employment trends, are weakening, and concerns about the health of the U.S. consumer have intensified while inflation continues to moderate. Historically, U.S. recessions have been closely tied to the job market. And this definitely seems to be the case, not just in terms of the job market or the strength surrounding it, but also unemployment. It's typically seen that whenever unemployment actually peaks, like it did right here in June of 2003, after the dot-com bubble, and that occurred obviously in 99 through 2000, Y2K, right? We saw quite a collapse in the equities or stock market, the S&P 500, right? Unemployment actually peaked after we saw the bottom and the market started to recover right around here. Okay, in similar fashion, as you can see here, right, market peaks right here, then market crashes in 2009, in 2008, right, the Great Recession, if you will. As you can see here, unemployment peaks right when we start to recover and the bottom was already in. In other words, this unemployment reading is a lagging indicator, except for one situation or scenario which occurred, and it was the nastiest one we've ever seen in our recent history and arguably the last century, okay, was the unemployment surrounding COVID. And so that occurred around the exact same time we saw the collapse. We saw a V-shaped recovery because of endless money printing, what they call QE. So that said, what we're looking for is a turn up, okay, and consecutive higher highs in terms of readings on unemployment. So whenever you start to see unemployment peak or start to climb and trend up as markets signal that there is some weakness and the market starts to trend down, that's a good indicator that if you continue to get these higher readings, that something is seriously wrong, and markets usually respond by selling off. Okay, then unemployment continues to climb while markets have already put in their lows. So it is very much possible and potential that although, again, we're seeing the market continue to rally, the S&P 500, unemployment is actually getting higher and higher in terms of its readings. And so if we start to see weakness in the S&P 500, it's likely going to affect the crypto markets, and this unemployment reading is likely to continue to climb. Now, I don't know know if our next high is going to be at 5%, 6%, or even 10% like in the Great Recession, but it is very much possible. And so that's something that you want to be aware of. Then we have another negative reading here on the ISM PMI Purchasing Manager Index. This is typically a leading indicator. I have a red line here that is at 45. 45 is typically indicative of anytime we are below that, it is a sign of serious market weakness and what could potentially be a recession. So that said, you can see here in 2020, we bumped below it. In 2008, 2009, we definitely dumped below it and stayed there for quite a while. Even in 2000 to 2001, right, we had these readings come in earlier and actually give you a really strong signal or as a leading indicator before the actual bottom occurred in 02 and 03. We were actually starting to recover on the ISM. So this is a good leading indicator. And as you can see here, we have been consistently trending down now. So we saw our major high in 2021. Things actually dumped quite hard, and since that point in time we've actually failed to rally to the upside, and now we're starting to see weaker readings. So if we come below here, then chances are it's going to start to show up as well in the S&P 500 and in crypto markets. And our third and final indicator would be that US 10-year US Treasury yield over the 2-year Treasury yield. Whenever we get a yield curve inversion, that is typically an indicator or a signal that markets are looking really weak. In other words, you get more yield on the 2-year than you do on the 10-year. Right here I have the 1% line, so this is the yield curve inversion. Whenever we bump below there, very indicative of, and this is a very strong leading indicator, okay, that the market is seeing some serious weakness and we are likely to see a dump. Whenever things start to normalize in terms of the yield curve, you can see right up into these ranges, markets look relatively strong. Well, this is the longest that we've remained here since 1929, right? In the major collapse of that period, the Great Depression. And so now we're at a situation where the yield curves are starting to look like they might actually normalize. Okay, but by the time they actually start to normalize, as you can see right back here, market starts to dump. So all of these indicators actually have hedge funds sitting out of this most recent rally. And in this article from Reuters, it explains that still uncertain on where US stocks are headed, equity hedge funds are sitting out of the market rally despite taking bigger paper losses on bearish bets since June. And right here, they state that this is probably one of the most disliked rallies in the market across all client segments, said a prime broker at a Wall Street bank, noting funds have been selling long positions into the rally. They're getting out, and that's actually been very much indicated in the volume on the S&P 500. And as you can see right here, this is pretty indicative of distribution, right? This is where people are starting to sell. We had some massive selling right here, right before the high, and it could have potentially marked the high, but it seemed that we had a bit more momentum left in us. Then we saw another major distribution day right here. And yet again, we've seen more and more distribution days in terms of volume over and over and over again, increasing volume on the sell side and declining volume on the rally. So this major sell-off on this day is likely to be followed up with some more sell-offs and continuing growth in the sell volume. In other words, stocks are rallying largely because some investors believe the Fed will pull back on tightening monetary policy sooner than previously expected, although Fed officials are not promising that. And due to macroeconomic uncertainties, hedge funds have significantly reduced their overall risk this year. In other words, this rally, it not only looks weak from a volume perspective, but looks like it was an opportunity for people to start to get out of their long positions and could have potentially also been a major short squeeze. A lot of people were short here, right? Then they were squeezed out of those positions on this major volatility, only for the market to continue coming back to the downside. However, BlackRock and now Morgan Stanley seem to also be bullish, which is a good sign that they might have data that we simply don't have in order to create these outlooks. No matter the winner of the year's U.S. presidential election, investors should consider how government spending and debt can lead to higher inflation and how tariffs in response to trade tensions can fuel price increases. In terms of the equity outlook for the year and through into 2025, the 2025 earnings forecast for the S&P 500 has been rising, and that suggests that the index could be closer to $6,000 by the end of this year after climbing past $5,000 in February. Still, there is a caveat, right? And that's the fact that US stocks and markets don't typically move in a straight line. The last drop of a size of about 10% in a single year happened in the fall of 2023, so the market might be due for another steep drop, which kind of leads me to the whole theory about what's going to happen through the end of the year. We're likely going to see the S&P 500 come down to break below this previous low for a new low, and then at some point in time see some buy pressure or support. It's very much likely that any major volatility in the S&P 500 might lead Bitcoin and XRP and general crypto markets to also dump. However, what I'm looking for is more strength in terms of the buying on those dumps in the crypto markets, and if so, that would be indicative that those are good dip buying opportunities. In other words, let's say the S&P 500 dumps for a double bottom right here, but Bitcoin actually dumps and also double bottoms only to see a strong rally, while this fails to see a rally and kind of just, lags around in this space. Then that would be a good indicator that there is some serious, buy volume and dip buyers in this range here. However, if they both break down, right, I'd kind of want to wait and be patient and just buy some major supports like at the 42 to, $40,000 level, and that would actually be a really good time to add to your bag. In this case, where would XRP go? Now, the good news is when you look at the price of Ethereum versus Bitcoin versus XRP in terms of their relative strength, it's actually quite impressive since July 5th of this year, how XRP has not only maintained a strong price range, but has actually maintained strength relative to both. Okay, this green line is Bitcoin and the purple line is Ethereum. Okay, so as you can see in the same time frame, Ethereum is down 15%, Bitcoin is up 4 to 5%, while XRP is up 35%. So this is exactly what I'm talking about. If we start to see relative strength versus the S&P 500 to Bitcoin, so Bitcoin is not only getting bought up far stronger on the dips, but it's dumping less. Okay, that's a good sign of a strong crypto market. 1. 2, the fact that XRP is looking stronger than both Bitcoin and Ethereum is also a good indicator of relative strength and dip buying from some major players in the space, which would lead me to believe that any dump, okay, will not only get bought back up more seriously on XRP, but that whenever we actually bottom out, XRP is going to be ready to fly. So if we start to dip, where exactly would XRP go? Well, my first major ranges of support would be about 46 to 43 cents. On any major wick, we could potentially dump to 38 cents, but that remains to be seen. If we see a lot of buying here, okay, or even a strong support here, even though the other markets are starting to collapse or crash a bit, then that would be a good indicator that there is some serious strength and accumulation with XRP. If markets seriously tank, okay, and XRP follows suit like it always does, okay, even though right now it's showing more strength, doesn't mean that it can't dump a bit more with other markets. It also doesn't mean that we're going to dump. I'm just giving you some potential scenarios and looks at this market. Then I would definitely be buying, like when we're talking some serious lifetime buys, anywhere between 33 cents to 30 cents. If we wick down hard, okay, down to let's say 22 cents or break below here at any point point in time, and we're talking like 28 cents max, then I would seriously be back in the truck up to buy way more. I'd probably take on a bit of leverage too. Okay, not so much that it would bankrupt me and I would lose all my money if it continued to dump, but just enough that, let's say I could, toss $500 to $1,000 at that play with a 5 to 10x leverage. I'm not recommending you do this, but this is what I will be doing. Okay, and that if we continue to crash or collapse for whatever reason, I lose that money, but I'm not losing my entire crypto portfolio or bag. On the flip side, it could also be a very good place to add to a position with leverage, because then it gets bought right back up into one of these support ranges, and this really gives it the room it needs and gives it the strength it needs in order to break out above that 75 cents resistance range for new all-time highs in a 2024 bull market like Morgan Stanley just shared. So one last time, I hope you got value from the video. I hope you learned something. I hope it helped you to create a strong game plan and gave you some things and key indicators to look out for. But if you haven't already, go to bullrunners.com to discover how to earn more crypto in less than 10 minutes with the #1 play to earn XRP game. So whether you're going to be stacking to your bag, whether you're already sitting on a bunch of XRP that you're not going to sell because you've been investing for quite a while, this is the perfect way to not only accumulate more and compound your bag if we continue to trend up and see a major bull market, but if we see any volatility, this is a great way to reduce your risk and the volatility in your portfolio by actually earning crypto and putting your XRP to work. Yes, the crypto itself in this game is convertible for XRP, and we show you in the videos on the other side once you subscribe. So go ahead and do that. Also subscribe to the channel if you enjoyed the video. Like the video, it really helps us out, and I look forward to seeing you in the next video, my friend. Goodbye.